fun and games today with the Bank of England, and it's announced that it's not going to do its QT, but instead it's going to bring back the old favourite, it's going to bring back QE. This is in response to a meeting this morning, which is between the Chancellor of the Exchequer, Gossi, and some of the banks, insurance companies. Basically, they have said that he needs to amend course in some way, and that the amount of money which they're intending to borrow may run into difficulties. We need to go back to history on this one. In the history, if you go back to the 2008, the banking scam, when the US, the UK, other countries put a lot of money into the banking, financial, bailed people out. They put so much money into this, they took so much debt on board, that basically they needed to keep the interest rates as low as possible. These were manipulated down by the Fed, by the BoE, and by the ECB. Obviously there's other banks in the world, Bank of Canada, Australian Bank, blah blah blah. We'll just concentrate on these three. The debt went up, the interest rates stayed low. We came to the junction in the road, 2020. There was a little bit of some exports from the Middle Kingdom, which a lot of people didn't really want, but they had to deal with. And what that did was that then increased the amount of spending. Furlough, eat out to shop out to eat out, whatever. All of the schemes, stamp duty, reduced, taxes reduced, blah blah blah. Amount of money that was borrowed through the roof. We've got the Yankees, which are in excess of 30 now, trillion that is, that's 30 million dollars, and the UK is round about 2.5 trillion. That's 2,500 million pounds. Yeah, which kind of works out to about 75k sterling per taxpayer. That's the debt per taxpayer that you haven't to pay interest on. So we'll whiz it forward. Boris exits stage left, and we have a little bit of a battle. We have Richie, and we have Trussie, and Trussie wins, and Trussie says let's go back to whatever is conservative values, so we want to lower taxes, and to do that, because we're sitting on this 2.5 trillion mega pile of debt, to do that we're going to need to increase that debt, because we've got the lecky, and the lecky prices are going through the roof. So we need to borrow some money for the lecky as well. So we've got the lecky, and we have got the lower taxes. So the gamble is, you go to the hole in the wall, you get your quids out, you go to the casino, put on red or black or whatever, which one you fancy, doesn't make a difference to me. You hope that you'll be able to win, hightail it round to the bank, put your winnings in the bank before the bank tells you that you're overdrawn. The only difference between what I've explained there and what the UK government's doing is just the scale. What the UK government's doing is saying, we'll borrow this shortfall, this deficit, in the hopes that we can make the GDP, gross domestic product, the services, the goods in the country bigger. We will make the pizza pie bigger, and the tax slice, this new tax, because the pie is bigger, will cover for the lecky and cover for the lower taxes. Pie is bigger, we get more taxes. Other people have said this seems to be a bit of a gambler's paradox here, paradise. Lots of people have stood up and said this won't work, blah blah blah. You've got MFI or IMF or whatever saying that you shouldn't be doing this and you're putting yourself at risk. The risk is that you can't make the pizza pie bigger and you're going to be left with an even bigger deficit debt of $2.5, maybe $3 trillion by the time it all winds its way out. The problem that you've got here is that it's somewhere between 60 and 150 billion quids more. So that's 60 billion to 150 billion more. So that's like taking the debt at the moment somewhere in the region of 2-3. So if you say it's at the higher end, you're looking at 245. Let's just round it off. You know, what's 50 billion between friends? That's 2.5 trillion, but going up. The other things which are in the mix is the government's gilt portfolio is approximately 25% index linked. In the US, they're called TIPS, inflation bonds, treasury, inflation, blah, blah, blah. What this means is when the interest rates go up, the UK government has to keep in line with inflation. Inflation at the moment is 10 plus, whatever number that you fancy adding to it. It's certainly not 10 in my personal circumstances. Your personal circumstances, it may be 0, may be 10, may be 15, may be whatever. For most people, it'll be plus 10. The consumer price index is saying, you know, it's 9.999999 recurring. Didn't want it to be 10. 10's too big. But it could be higher. Could be higher next year. So last week, the Federal Reserve, the difference between is that the Federal Reserve is recognises that there's an election coming up in November in the US, midterms. So everybody's complaining in the US about the high inflation. Inflation's too high. It's just too high. The gas prices are too high. So President Biden, he said, yeah, it's too high. Take all the oil out of the strategic oil reserve and pump it into the market. And that'll take the petrol gas prices down a bit. So there was a big pile of oil. It's about half full now. He's taken about half off and sold it off. So the Federal Reserve saying, yeah, we've been tasked with loads of things. Initially, it was price stability, keep it at 2%. And then they added to keep in unemployment low. And now as well, I think they've got to global warming or something that they've got to add as well. So they've got a triumvirate of three things, but the big one is to keep the inflation to 2%. They can't keep it at 2% at the present time, so they've changed the definition. It's 2% over some mythical time that they haven't told anybody. Is it a year, or maybe it's a bit longer, 5 years? Ooh, depends what it is. All that'll happen here is we'll game the system. We'll get it to make 2, or we'll start our clock rolling from 2000 or any time when there was bits of low inflation, and we'll say, look, over the last 20 years, it's 1.99. So at the moment, the Fed, because of the impetus and possibly the requests from the White House, is we want the Fed rate, the bank rate, to be increased. So they've been bumping it up, 0.75, 0.75, 0.75. Meanwhile, back in Blighty, the Bank of England, what's the Bank of England been doing? Well, they started a little bit earlier, but it's a bit sclerotic. It's a bit George the third or the fifth, or whichever George it was that lost the colonies. So they've been putting it up, but they haven't been putting it up as fast as the Yankee Doodle Dandies. So what's been happening is you've got all of these squids and dollars and that lying around in the banks, and people saying, well, I'll get rid of me squids and I'll put them into the old dollar-roonies, because the dollar-roonies is paying us a higher rate of interest. And on the global scale, the dollar is more secure, less risky than the squids. So a lot of people have been cashing in the squids, getting your gilts, get them paid off, run across the Atlantic. Can't do it on the Concorde anymore because they ain't there, but they've been using the old net, and they've been buying the US Treasuries. Yay, there you go. What's happening is the US is sucking in all of this money. It's like a Linda Lovelace affair. It's been sucking it in. It's been getting lots of money flowing in. So go back to the Bank of England. So the Bank of England is just meandering along here. Put the old Federal Reserve. Yeah, it's got the old Nikes on, and the Federal Reserve is here. I'm running this way. Bank of England's just looking at its mobile phone, saying, yep, I'm coming after you. So this gap is everybody turning their squids into the dollars. The difficulty is, obviously, in the UK, the insurance companies, the banks, they have regulations, the pension companies have regulations, and some of the regulations is that they must have UK gilts. So there's a limit to what they can do. The problem that they have with the UK gilts for the insurance companies is nice and simple. And they buy the gilt for whatever it is, say 100. It's got a coupon on it, if whatever it is, 5%. Because the Bank of England is putting the rates up, the new gilts which come out, let's put this at a more realistic level, 2%. The gilts which are coming out are in excess of 2. So this is depressing the price of the bond, goes down, it's just a seesaw. Price goes down when the interest rates go up. So the new, say, the new 10-year gilt, it's maybe going down to about 4%. So you've lost money. So you've got all of these banks, all of these pension companies sitting on losses. They've been buying the gilts. They're now standing to make a loss. The Bank of England's told them that we're going to be putting the rates up again in about 6 weeks' time, and we'll keep putting them up until we get inflation under control. Everybody here that's carrying these UK gilts is looking and saying, I don't want to be carrying UK gilts. The interest rates, the Bank of England's telling us it's going to go up. I need to get shot of these. I need to go and get myself some really smart, Yankee Doodle Dandy treasuries, them nice greenbacks. So, Kwesi, last week, Kwesi had the mini budgets. He says we're going to borrow all of this money. People are saying, yeah, where are you going to get all of this new debt from? Who is going to buy it? We ain't keen on buying it. We want to get shot of the debt that we've got now. We want to buy the Yankee Doodle Dandies. Who's going to buy the debt? So what's happened is the Bank of England was supposed to be doing a bit of QT. That's selling some of the QE which they bought. This was when the penny was on the go in 2020. Bank of England bought all of these bonds, keeping the old liquidity in the market, keeping the interest rates rock bottomed. Times have changed because they've dumped all of this money in. This has caused the inflation. The inflation has put the prices up. People are confused. People are saying the prices is the inflation. Oopsie doopsie, no it's not. The inflation is the increase in the money supply. The prices is the result of it. What we need to do is we need to do a bit of QT, and we need to sell some of these bonds that we've got on our balance sheet, and we need to sell the bonds and put them back in the market. That's what the Bank of England was going to do. The Bank of England is put the old foot on the brake. No, we're not going to do that. What we're going to do is we're going to do QE again. We're going to do QE, and we're going to buy all of this rubbish that the insurance companies and banks and people like that don't want, and the Bank of England will put them on its balance sheet. Where will it get the money from? The Bank of England has got one of these magic keyboards. It's the magic money keyboard, and it just types a few things on here, and it creates unlimited amounts of money. What does this do? Better go to the top because I'm running out of space. What this does is it makes the money supply increased. If you increase the money supply, you get inflation. Hang on a minute. Bank of England says we're trying to put the interest rates up to bring the inflation down. If we now do QE now, we're going to help put inflation up. And therefore, ergo, QED, we need to raise the old rates higher, faster, bigger, whatever. So what are they going to do? Raise them by 2%? Who knows? What's happened is the Bank of England said, yes, we will buy all of this, let's call it toxic. We ever heard that one before? Is that 2008? Oh man, toxics. Yeah, not quite as toxic as that, but toxic enough. The Bank of England's now buying some of this debt which the banks and the insurance companies and the investment companies have on the books, because they are looking around and they are saying, oh, if we get margin called on this, we're going to have to dump some of these bonds. We might have to dump them at the bottom of the market because the rates are going down. Sorry, the interest rates are going up, the price is going down. We can't have that. Everybody knows bankers don't lose. Anytime the bankers look like they're losing, we've got to get shot of this stuff and we've got to put it into the public domain and we've got to let the taxpayer pay this off. So that's what's happening at the moment. The banks are going to sell to the Bank of England. Bank of England's going to take all this rubbish, it's going to put it on its own books. This is going to give liquidity, a bit of liquidity. There's a glass of liquidity with a bit of a frothy head on it. The banks are going to give, the Bank of England's going to give the money, buy all these old rubbish, toxic bonds, which the insurance companies and the banks hold, and the banks are going to be liquidated. No, they're not. They're going to get liquidity. And that liquidity, what they're going to do with them? Well, they've got a couple of options. They can buy some of the nice new bonds that the Bank of England's going to, the Treasury. It's the Treasury, yes. Yeah, the Treasury's going to be selling heaps and heaps, somewhere in the region of 60 to 150 billion more than what they were going to. They're still selling a load, so this is an increase. So the Treasury is going to sell these 60 to 150 billion more. Who's going to buy them? Well, with this new liquid money that you've got, by selling your old bonds, new lamps for old, the banks could buy these, because they're going to have a nice new higher rate, 4%, 5%, 6%, whatever. They could do that, or they could go and buy some greenbacks, because the Yankee Doodle Dandies, they are raising theirs even faster. Then you've got, who knows what the ECB people are going to come up with. They're going to have to come up with something to keep money in Europe, otherwise the money's going to float across to the US. If you're looking at what's the bigger risk of default, the UK versus the US, well, it's quite easy in that the UK is a bigger risk. So you've got a risk premium on here. Realistically, your UK bond should be paying you a higher rate than the US bond to compensate you for the risk that you're taking. UK versus the Euro. Same. Euro is bigger. UK is a higher risk than what the Euro is. UK has to have a higher rate to compensate for that. So basically, Quasi is being round, it's been taken to the woodpile, it's been given a good talking to. He's had a chat with the Bank of England. Bank of England, so independent, is agreed to buy all this rubbish. So it's going to buy all the rubbish. It's going to stop trying to sell the stuff, QT. It's going to buy even more stuff, QE 22 plus 1. It's going to make its balance sheet even bigger. At some point, unless this all goes pear-shaped, at some point it's got to get shot of all of this debt, the QT. UK national debt, 2.5 trillion, you might as well call it that. That's just the known debts. So the Bank of England has got to row in both directions at the same time. The Bank of England's got to put the the interest rates up, and at the same time it's possibly going to be doing QE. These two work 180 degrees opposite to each other. QE puts liquidity into the market, interest rates take liquidity out of the market. These tend to cancel each other out. Will things change tomorrow and the next day and the day after? Will the Bank of England do an emergency, super emergency? Well, we had another think about it. Could be a good idea. Maybe if we put the Bank of England interest rates up to 5%, stop fannying around. Yeah, we'll do that, and we'll also buy 100 billion of your bonds, of your gilts. Who knows? All you can say is that it's not going quite the way that I think Prime Minister Truss and Chancellor Kwasi thought. The idea is good. Everybody would like lower taxes. The idea is good. Everybody would like lower lecky. The difficulty is how you circle the square, how you do this. Prime Minister Truss has went along the path of go to the cash machine, get the money out, put it into the casino, hope that you win, take your winnings, get to the bank before you've got to pay your Visa bill. So it's a race. The opposition, the other parties, they just say tax, 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 tax everybody, tax the lucky companies, tax anybody, tax the granny in a mobility scooter, tax him, tax them, tax this, VAT up, that up, yeah, NIC up, yeah. And they pull this age-old thing, which is they say that this tax will be ring-fenced and it'll only be for doing this, that. It's meaningless saying that. All of the taxes go into a big pot. It's like all they're saying is we wanted to spend 10 billion on this. We are going to say that this 10 billion comes from not raising the NIC or the higher rate tax or this tax or that tax. It's meaningless. The only thing that people should be considering is the total tax that they have to pay. The total tax and where that money in essence is going to. You don't need to be saying, oh, we're going to, all of the money that we get from this that we're going to spend on that. It's a nice thought. It never happens in the real world. Okay, so we will wait and find out what happens. Time to put the kettle on.